tiring out a little bit, we can go ahead and get started at least with the introduction to Tom and thanking everybody for coming here. So real quick, hi guys, my name's Keith Bender. I'm an investor here at Pear VC. We're an early stage venture capital firm in Palo Alto and San Francisco. I went to HBS. I know I did not get to take Entrepreneurial Failure with Tom, but I've learned everything that I could have hoped to learn from that class and more. They're reading Tom's latest book, Why Startups Fail, New Roadmap for Entrepreneurial Success, as it disappears into my Zoom background here. We're really pleased to have Tom join us and to share some of the wisdom that he's accumulated in researching this book and preparing this class. And we'll get to all that in a second. I just want to thank Tom for coming. Tom, for those of you who don't know, is the Howard H. Stevenson Professor of Business Administration at Harvard Business School. I think that this is a worthy shared professorship for Tom. Tom is effectively the dean of all things entrepreneurial at HBS, and Howard Stevenson was one of the ones who famously defined entrepreneurship as the pursuit of opportunity beyond resources currently controlled, which we'll talk about in a minute. Certainly one day expect that there will be a chaired professorship for the Thomas R. Eisenmann Professor of Business Administration with perhaps some of the insights from this book. So in addition to teaching MBA students like me, Tom's also the faculty chair of the Harvard iLab, which serves entrepreneurial pursuits across Harvard more broadly and leads many other entrepreneurial organizations at HBS, including the Rock Center for Entrepreneurship, the Harvard MS MBA program, and the Harvard College Technology Innovations Fellows program. On the academic and teaching side, Tom has led the hallmark HBS course, the Entrepreneurial Manager, or TEM, and launched and led several popular and enduring elective courses, including a course, as I mentioned, called Entrepreneurial Failure that has both inspired and been inspired by research for this book. Tom is also, as he relates in the book, advised and supported scores of startups and thousands of students in nearly 30 years at HBS. So he's been on ground zero for many of the lessons that come to light in why startups fail. And that's what we're here to discuss today. It's out this year. Hope that for those of you who weren't able to score one of the copies that we'll be mailing to you, you'll go pick one up before too long. So thank you so much, Tom, for being here.
Keith, thank you for having me. Thanks to Pear for hosting, and thank you to the Pear community for your interest.
Awesome. Well, the plan for this session, everybody, is we'll do a quick masterclass in entrepreneurial failure based on themes and lessons from Tom's book. And then anything we don't cover, we'd love for the audience to raise in the question and answer tool. We'll discuss at the end of our time, have 15, 20 minutes for those. So please use the Q&A feature. It'll ensure that all your questions get routed to our panelist inbox here. But before we really dive into the major topics of the book, let's maybe, Tom, start with Howard and what we're aiming for. In your kind of insightful, this empathic letter to founders that you have at the conclusion of your book, you encourage founders to go out and build something great because the world needs entrepreneurs to solve pressing problems. With a nod to Howard, these are founders, these are entrepreneurs. What does it mean to be an entrepreneur at its core? What's its end goal?
Yeah, well, I'm impressed that you served up the definition verbatim. I tailored it a little bit for the book. So pursuing novel opportunity, doing something new, and by its nature, because it's new, something risky, without resources, or at least without all the resources at the outset that you need to actually capture the opportunity. And that's, I think, a pretty good definition of entrepreneurship. Somebody doing something new and something risky before the resources are in place. So it's the difference between Dropbox, Drew Houston with an idea, literally his experience, his contacts, but he had a thumb drive in his pocket, versus Google Drive. When Google launches Google Drive, they have legions of engineers, they have data centers all over the world, they have customer relationships with hundreds of millions of customers. So launching Google Drive and launching Dropbox is the difference between innovation and entrepreneurship.
Makes sense, but it carries risks, no doubt, and perhaps innovation within an organization like Google may have a higher success rate. It's by no means guaranteed a success, but entrepreneurship carries all types of risks. And of course, the failure to overcome those risks leads to failure of the entrepreneurial enterprise in and of itself. So how many startups fail and fall short of this mark?
This is where I get to be a professor. So professors love to mince words, professors love definitions. So if you ask how many startups fail, then you have to define startup, which I think everybody on the calls think, what is he talking about? Isn't it obvious? Well, it's not really. Like, when does a thing become a startup? If you're working part-time on it and you still got a day job, have you launched a startup? I don't think so. And what do we mean by failure? Likewise, does it have to shut down? You can go bankrupt without shutting down. The definition of failure that I use in the book is investors did not or never will make money. And that's one definition. That's from the investor's perspective. You might say, well, what about the founder, right? What about their goals? If they had personal goals to change the world, to build a great team, just to go along for the ride, maybe the business didn't make money for the investors, but it was a success from the founder's perspective. And the reality is, by the time you get to late stage, sort of Series D or 5 years in, sort of pick a number, something like only 40% of venture capital backed startups are led by a founder CEO. And so, once you bring in that much outside money, and the founder's goals are still obviously very relevant, and I keep them in perspective in the book. But this test of whether investors have made money, and by that test, sort of for venture capital backed startups, something like 2/3 don't yield a positive return to investors. I should add too that it's not a perfect test either, because there are plenty of businesses out there, ventures out there that make money, but from society's perspective, we wish they would go away. They may do ecological damage or exacerbate income inequality. There's addictive products that do more harm than good. You want to look at a lot of different stakeholders. The founders matter, the investors matter, society matters, but by any definition, somewhere between half and 90% of startups fail.
So given that we've defined startups, and I think we're on the road to defining failure in the academic world. Once you've defined something, you might as well go study it. Why should we study startup failure?
Well, it's tempting to think that failure is just a photo negative of success, sort of the things you would do to succeed. If you fail to do those things, you may fail, and that is true in large measure. But there are actually some things, particularly focused on venture capital backed startups, that you need to do to succeed that also can boost the odds of failure. So most notably, hypergrowth. What a venture capitalist wants is a successful, fast growing business, but the very act of growing fast can cause an awful lot of problems for a startup. You can grow fast to the point where your customers are worth less than it cost to acquire them. You can grow so fast that operations become chaotic. It's hard to recruit the right people to fill the jobs and so forth. So it's important to understand failure because it boosts the chances that you can anticipate these failure patterns and hopefully avoid them, take steps to avoid them.
One thing that we try to do as investors is try to predict the likelihood that founders will fail at whatever they're working on. And a lot of times I think we come to the conclusion, good team, we really like the founder, bad idea. And then it leads to the inevitable question, if a team's so good, why have they picked a bad idea? How can those two be true at the same time? So is that the wrong way to approach it? Is there something deeper going on here? And, what other factors should we think about considering as we look to diagnose the pitfalls an early stage venture may encounter as we're evaluating it, or as founders are evaluating investing their life and resources into this journey?
Yeah, if you get a lot of investors going, you'll hear about horses and jockeys. It's your version of the founder, the jockey, and the idea of the horse. And I came to the conclusion in researching the book that that framework isn't particularly helpful, that there's just, it's not just the founder whose time and ideas contribute meaningfully to the success of the venture. It's other team members. It's the outside investors. They bring not only money, but advice and contacts. And most get back to the definition of entrepreneurship, without resources. Who has resources? It's often bigger companies. They provide either essential technologies or distribution channels. So that whole constellation of players has to be aligned and has to be in sync with whatever opportunity the venture is pursuing. And there is a pattern out there where you have, it's the opposite of what you spoke about. It's a good idea, but a bad set of players. I call it in the book, bad bedfellows. And that's kind of heartbreaking, right? You know that this is a promising venture, and it's again a head scratcher. So, okay, if it's a good idea, why can't you find another co-founder that can round out the co-founding team? Why can't you attract good employees? And what I learned about this pattern, it was vexing. It's really was a catalyst for the book. I had a pair of students who went off to consulting for a year, but hated that, and sort of were cooking up a concept for an entrepreneurial venture the whole time. And the concept was they were two women who had trouble finding work clothes that looked good and fit well. So they wanted to do better fitting, affordable, and stylish professional apparel for young working women. And they did textbook perfect minimum viable product testing to validate demand. There was demand. Raised $1 million. They tried to raise $1.5 million. That turns out to be an important part of the failure story. Launched the business. The demand was strong. Repeat purchases were solid. But the promise was better fit, and their rate of returns, product returns, it was a direct-to-consumer site, was on par with other e-commerce sites. But when your promise is better fit, you don't want the apparel to not fit well. And it turned out, when you sort of parse it all through, the failure of the company just a year in was really disconcerting to me. Here I was supposedly an expert on entrepreneurship, and I was a failure at understanding failure in this context. I couldn't point to the exact reasons why this company had failed. I saw a lot of patterns, but I couldn't pinpoint the root cause. But as I dug deeper, what I realized is apparel manufacturing and design turns out to be a place where you really need domain expertise. And I'd had just a year earlier, a great experience with a startup, again, a pair of HBS founders, Rent the Runway, just what it sounds like. If people aren't familiar with the business, they started out by renting party dresses you could rent for $100 something that would cost you $800. And that was a fantastic idea, because you'd never wear that $800 dress again once the photos appeared on Facebook. And so they didn't know anything about fashion, but they built this fantastic business, raised a ton of venture capital. Business is still very successful. And so I thought, okay, well, Quincy Apparel, the second one, would be fine. And it turns out there's a world of difference between renting dresses and designing and making dresses. And so the Quincy team didn't have any experience with apparel design manufacturing. They hired industry specialists to come in. There's all these specialized roles: fabric sourcer, pattern cutter, quality control, and on. And all these pieces have to fit together and hand off the work from one part to the other. And they hired people from big companies who knew these functions, were specialists, and these people had no idea what the rhythms were in an early stage startup where everybody dives in to sort of help put out whatever fire is burning hottest. They would sit on their hands and say, well, I'm the pattern maker. I have no idea how to solve that problem over there. So the team didn't pull their weight. The factories, it's quite common with apparel to outsource manufacturing to third-party factory, didn't pay any attention to this poor little company whose founders had no industry reputations or relationships, whose sizing requirements were quirky, whose orders were small. Orders would get pushed to the back of the queue if some big customer came in needing something expedited. And the investors turned out to be not very experienced, classic, looking for a direct-to-consumer growth story and pushing the team to build inventory when they should have gone slower and figured out the production process. So example, did you pin that one on the founders? Well, yeah, more industry experience would have made a big difference. But the big lesson I took from that is domain experience, industry experience is so important in some instances and really not very important in others. I can point to a lot of business like the Rent the Runway business where understanding fashion just wasn't that essential to their success. So, everybody listening, try to figure out if you're in a zone where industry experience is crucial. A hint: if you're in food and beverage, you need a lot of experience. That's another brutal one.
So I understand the need for experience, and it's hard to find somebody with experience, right? So how do you mitigate the desire to just kind of silver bullet your way out of this problem by jumping at the first person who has quote experience and bringing that person on? I just imagine that if you don't have experience in an industry, you're going to have trouble evaluating who actually does have experience in an industry.
Boy, right on the nose, yes. And not only will you have trouble evaluating, but you don't have a network that's very rich with candidates. So here's where Pair can add a lot of value, and other early stage investors. Have an investor who has the network, have an advisor or an investor who's actually got the domain experience, who can do at least that part of the interview for you, the skill part, right? You, the founder, can still, you're always recruiting for skill and attitude. And the founder can still take charge of figuring out, is this person going to fit into an early stage startup? Understand the rhythms and the chaos, and which some big company people can do and many cannot. So yep, and it's particularly challenging. Why would somebody with deep experience join a co-founding team where the two co-founders have a good idea but lack the know-how to make it real?
In your experience, I mean, have any of the teams you've advised really solved this? Like, because I know so many early stage teams are just outstanding at hacking product market fit by like proving an MVP hypothesis or something, right? But what can they do to, absent even some external perspective, ascertain, does this person know what he or she is talking about? In bringing on an advisor, even in evaluating an investor. I think about, the Quincy team, and like they thought they had checked that box by having folks who knew Warby Parker and Bonobos and other really strong D2C startups of the day.
Yeah, their investors had been angel investors in those businesses, but as I'm sure the folks at Pair would confirm, there's a world of difference between being an angel investor. I'm an angel investor in a lot of startups. I almost never hear how it's going, as opposed to a board member who, particularly in an early stage company, the board will meet once a month, and a engaged board member will be, a couple times a week on the phone or on email with the founders. So and that was the mistake I think the Quincy team made, is they assumed that their investors had relevant experience because they'd made investments, but it takes more than that.
What about when somebody comes to you and says, hey, like, we'd love to be your channel partner. We'd love to, in popular parlance today, collab, right? What, like all these people who want something from you or want your business in some way, but they maybe don't want to pay for it, or they want you to give them business, and, they're selling you on the proposition of why it's, they're going to bring some capability that you don't have. How do you think about finding these partners?
Are you thinking like a manufacturing partner or an accelerator partner?
Yeah, either manufacturing, distribution, anything core to making the product and getting it in the hands of the people you'd like to have it.
Yeah, no. This is one of the hardest things for an early stage startup, right? Because it's the very definition of asymmetry, right? Little thing here with no track record and not much capital, and a big thing with all sorts of resources. So many things can go wrong when you try to make that deal. The big company may be just kicking your tires because you're doing something interesting in their space, and they're just trying to learn from you, steal your idea maybe. The big company may have somebody who actually sees potential, but People get moved around in big companies all the time. So the person you thought you were negotiating with suddenly leaves the company or goes to a different part of the company. Just layers and layers of bureaucracy that slow things down. And now we have to get the procurement people involved. Now we have to get the lawyers involved. And so it's rough. Mark Andreessen, when he was blogging a lot, had a fantastic blog post that if you sort of Google Andreessen and Moby Dick, it's the Moby Dick theory of basically big company partnerships that he writes about. And spoiler alert, if anybody in the audience has not read this 800-page book and thinks they might, sort of mute me for a minute here. So Moby Dick is a great white whale. Ahab is the obsessed captain who chases the whale across the Pacific for 20, 30, 40 years, however long it takes, never catching him. Finally catches him at the end, harpoons him, and gets dragged under and drowned by Moby Dick. And Andreessen says that's the situation that an early stage founder faces in negotiating partnerships with big companies. You can't predict what they're going to do. You can't find them when you want them. They're so big, they may, even if they're good intention, they may just crush you because of their great weight. And yeah, I don't, what can a founder do? You can give them some equity, but that's messy because if they turn out to be not good partner, now they're on your cap table forever. You can go for somebody in the field who seems hungry for your business. And even that's a head scratcher, right? Because like, why, maybe they're just getting started and they don't really have the experience. Maybe they're not doing a very good job, so they haven't been able to hang on to their customers. You can threaten to sue, but that's not very credible. If they're in non-compliance, if you do manage to close the deal, because you can't afford a lawsuit. You can use your social media megaphone. That actually is probably the most effective thing a founder can do if they're having trouble with a big partner.
A lot of whaling metaphors in
Yeah.
We're gonna catch a whale. We're gonna get drowned by a whale. Venture is like whaling. I don't know if I've ever really seen a whale in person, besides just off spouting from its blowhole. But I think a lot about whales around here.
Well, just a quick aside, my faculty colleague, Tom Nicholas, he's got a wonderful history of the venture capital industry. And one of the early chapters is about whaling, 140 years ago. And it turns out that whaling ventures have almost exactly the same incentive structure as a modern venture capital backed company, sort of in terms of this, the investors put in this and get this much of the equity, et cetera, et cetera. There's a captain, there's a team. So, and most of the time it doesn't work.
Yeah. And it's not even the investors who are the ones left stranded on a ship that's, rotting in pieces in the middle of the ocean. Investors are like, how do I exercise my pro rata on this whale blubber that made it back to land?
That's right.
Cool. So we've talked a little bit about broadly, like why you want to avoid these bad bedfellows. And something that in reading the book, I hadn't really considered was in this diamond and square framework that we learned back at HBS. In fact, it's all of the resources. When you think about resources classically, you're thinking about, money and like physical assets and things, but all these resources are people, are relationships that you have. And it suggests to me that so much of the investment at an early stage for any founder is in choosing the right people. And I wonder, I guess, just in your experience, where that consideration ranks in the hierarchy of these are the checkboxes I'm going to run through ahead of launching this venture. Like, do startup founders who you encounter seem to get more excited about the market and the opportunity and this novel solution that they've identified before thinking about the people that they're going to work with, or vice versa?
I think it's all over the place. And I literally just before this session got off the Zoom with a current student who had just pulled the plug on the venture he'd been working on for most of a year, and basically because the co-founder wasn't committed. And we spent some time talking about, if you dial back to September when this thing got going in earnest, was there anything you could have done to sort of battle test the level of commitment of the co-founder? And I was joined on the call by a very seasoned venture capitalist who was at a loss. I was at a loss. It's just, there's a lot of faith that goes into this stuff. And I mean, you could say, try working on a big project together, sort of 4 to 6 week thing where, it's sort of a simulation. I mean, obviously it's better if it's related to the actual startup, but, a test drive, but hard problem. And I mean, the easy answer is it's balance, right? You have to worry about both the relationships you spoke about, and boy, you better worry about the idea too, because you're going to need both.
Yeah. Assuming you get this right, you get the relationships right at the outset, and all other things go well, you start trying to attack this problem that you've identified, fallen in love with, and believe that you have some solution to. And this is where we as investors come in, and I think we exhibit something that I like to think of as like a bias to build or a bias for action. We're looking for founders who are builders, and you identify in this book that this builder mentality is infectious for engineers and non-engineers alike. You identify examples of teams who are non-technical and who bring on technical talent very early on, and we get excited about that. We're like, great, everything's in place. And if it doesn't work out, it's okay. But what's wrong with that approach? I mean, like, shouldn't startups just pivot until they find something that works, and whirling dervish infinite pivoting?
Yep. You certainly should pivot when it's not working, and pivot based on market feedback. The problem, the failure pattern that this is related to, I call false start. Just like track and field or swimming, where the athlete literally jumps the gun trying to get an edge and gets penalized as a result. The entrepreneurship version of a false start is the entrepreneur just convinced that she's got the right problem and the right solution for that problem, and identity as an entrepreneur is somebody who makes it happen. So I want to build the thing and sell the thing as fast as I can, and I'm going to run lean. So I'm going to put it out there. I'm going to get feedback, and I'll iterate and pivot to a better version of the thing if necessary. And that's all good, except what that entrepreneur has done is they've skipped an upfront chunk of research. Let's call it research. It is what it is. Customer discovery research, Steve Blank style. They followed the Eric Ries part of lean startup, the minimum viable product building and testing, but skipped the Steve Blank, get out of the building, go talk to potential customers. And it's often the case that you really have to validate that by carefully asking questions to explore, have you got a strong unmet customer need? And then there's usually many ways to solve that. And what a good entrepreneur is going to do is act like a good designer. They're going to generate multiple solutions, quickly prototype them without doing a lot of engineering work. They can be paper prototypes. And get feedback on those, and only then converge on the problem and solution pair that you want to take forward. We're talking about maybe 4 weeks of work, and it's a pretty good trade because in order to actually build and launch the product and see if it's working, that might be more like 4 months. And so the chance, if you've skipped the upfront research, that first version of the product is going to hit the market, it might hit the mark, but more likely it's going to fail and you're going to end up pivoting. You've essentially wasted 4 months, and you could have, if you'd done the upfront work properly, you could have cut that really down. And so there's a whole bunch of reasons why the false start happens, and at the core, it's basically because entrepreneurs are people who they think they see the solution, they know that entrepreneurs make things happen, but really crucially, once you bring a team on board. Especially if you bring the engineering team on board, they're expensive. What do engineers do? They build. So give them something to build so they can stay busy. And that leads to a lot of problems. Teams think they're following lean startup logic, and in fact, they're following part of it, but they're skipping really important early steps.
What if you have an engineer? Like, what if you are a technical founder?
Then your DNA is going to be that of a builder, right? Engineers love to build things, and you can. So you want to, and you can, and your identity as an entrepreneur says you should. So there's a lot of danger there. And let's be careful about stereotypes, but one stereotype of an engineer would be a little more introverted than the typical, the hacker is not the hustler in that formulation, and may be happier sort of coding than out of the building talking to strangers. So, but even non-technically trained, we see a lot of this at business school, right? People who are MBAs who don't have technical training can't build, but they hear correctly over and over again that to succeed as an entrepreneur, you need great product. How do you get great product? You need great engineers, and they're good at networking. So they go out and find a technical co-founder or a vice president of engineering, or they scrape together enough money to outsource the product development. And either way, once you've made that move, you're going to feel pressure to put the people to work. So both technical founders and non-technical founders are vulnerable to the false start.
Yeah. Being careful of stereotypes. It's definitely the MBA students who seem to have the problem of finding the technical talent more than, the engineer needs. I need an MBA student. I cannot
Right.
get an MBA student anywhere. Like just a flow of people walking over Weeks footbridge over to Harvard and MIT being like, hello, looking for an engineer.
Yep. At least we're doing it now, and doing it with some humility, our students. It used to be pretty another story for another day.
Definitely. And I want to ask about that in a second. Like, if you're not a founder, if you're looking to join something, how you should be evaluating it. Because I think there are some pitfalls that you touch on that are relevant there. But I wanted to ask about this. Like, as a founder is sizing, her opportunity, often you're under pressure to answer the question, okay, what's your back of the envelope total addressable market? Like, and implicit in that question is it big enough? And so, of course, like any good academic student or somebody who's been in consulting or something will typically respond, like, let me find a way to make the numbers big enough. So
$1 billion. $1
billion, plus at least. And how do you force the discipline of calculating honest TAM, total addressable market? Does it have to be grounded in research? What can you do to ensure that you're being honest with yourself?
Yeah, I mean, you can have two versions of the books, right? Sort of, there's the version for the tax authorities, and there's the version you use to run the business. Here, what goes into the pitch deck might not be the same as, I don't know that you want to be dishonest with your investors, but so much of what gets served up as total addressable market is in the service of raising money and sort of trying to get investors excited. And that can get you into trouble. Same way, by the way, with lean testing, minimum viable. A lot of the survey work, a lot of the upfront discovery work is really just there to make it look like we've studied the market. And that's a slippery slope. It can get you into a lot of trouble. The other thing, Keith, is it's actually hard to size a market because there's always some enthusiastic early adopters, somebody foaming at the mouth for what I hope foaming at the mouth for what you're going to bring. And an entrepreneur needs those early adopters, but many businesses aren't viable unless you can bridge from the early adopters to the mainstream. And that's a tricky move. And this is, I think, another failure pattern. Another way that entrepreneurs get into trouble is they overreact to, it's a false positive, essentially. When we know from COVID testing, false negatives and false positives, entrepreneurs are very vulnerable to false negatives and false positives. False negative is a little bit tragic because it's sort of a signal that your business isn't very good. You may throw in the towel when 2 years later you read somebody did a SPAC and made a small fortune doing exactly what you had in mind 2 years ago. But the false positive leads you to commit energy and resources in a direction that may be the wrong direction. And sometimes entrepreneurs just go too far in meeting the needs of the early adopters, assuming that's going to translate over to the mainstream, but the mainstream may have very different needs. Dropbox is a great example. The early users were incredibly sophisticated software engineers who were, in terms of synchronizing devices and collaborating and so forth, were nothing like what Drew Houston and his Y Combinator application talks about creating something so easy to use his mother could store her recipes on it. So he had the insight that the mainstream users and the early adopters will be different, and had the discipline to take that into account in designing Dropbox.
Knew what to do to win over the early adopters too. TPS report.
Yeah, he took a leap of faith that leaving out the really advanced features, he'd still have something that was sufficiently superior to the sort of hacked together solutions they were working with at the time. And he was right.
Yeah.
He could have made the product much more complicated, and he didn't.
Yeah. What about, for those looking to join a startup, you might be inclined to see, like, you might be an early adopter yourself, right? And that's what could catalyze your decision to say, I'm going to leave my high-paying job and go join this company. How do you be honest with yourself about evaluating an opportunity for those looking to join a startup? If you're looking to join a startup, I think you're probably just by definition inclined to be more exuberant than not. And so how do you avoid that pitfall? I know it's not, a founder-focused one, but it's, I think, one that can just as easily contribute to some founder failure, right? Where in terms of bringing on the wrong people and things.
Yeah, I mean, whole bunch of thoughts there. I mean, first one that comes to mind is what's your learning style, right? I mean, you take a job for a whole bunch of reasons, but a high on the list ought to be, what am I going to learn that's going to help me at the next stages of my career? And it's often, not always, but often the case that there's nobody to learn from in an early stage startup. Like if you go into an early stage startup as the first product manager into a technically driven, where the founder is actually essentially, technical founder has been the product manager and the chief financial officer and the head of marketing and everything else, that's not a situation where you're likely to learn how to be a PM. So who are you going to learn from, and what are you going to learn? And are you the kind of person that likes to learn by throwing yourself into the deep end of the pool and sort of seeing if you can get back to the side safely? Are you do you need structure in your learning environment? The second thing would be just being honest about the risk of failure and what that means for your financial upside. I mean, if one of these things works, an early employee can make a lot of money. But as we've heard, most of them aren't going to work. So, there's some very simple spreadsheet work, which would basically be realistic about the chance it's going to work and what your options are going to be worth and what they're not going to be worth if it goes sideways or down. And then the last advice I'd give is just to sort of keep an eye on these early stage failure patterns, because I think most of them can be spotted in advance. Even if you're one of the first, like count on two hands, one of the first 10 employees of the place, you can see if somebody's headed for a false start because they've skipped a bunch of upfront work because they're so convinced they've got the right product. You can see if they're overreacting to early adopters. If you join within the first year, and you can definitely see if, or at least you can draw an informed judgment about whether this is a business where industry experience is super critical, and whether there is anybody on the team of players broadly defined that's going to bring that expertise. And if the answer to those things is not looking good, then think twice before you join.
Definitely. Just a note to all the audience members, please continue to use the Q&A feature. We'll gather your questions and start on those in just a minute here. If not, I actually see a couple of my Section C 2020 section mates in the audience, so I know who to call on to ask a cold call, to ask a question of Tom. Tom, part of the book, and something that we didn't cover as much here, is around what we might consider nice problems to have, those challenges you face that present failure modalities as you scale a business. And as you've identified, most startups don't graduate to that set of problems, but nonetheless, they're ones that founders should keep an eye on and try to lay a foundation and defend against as early as possible. So wanted to just, if you don't mind, give us a tour of what those are, and like anything early stage founders in particular, early stage investors, or people looking to join startups should be on the lookout for.
I see Mar Hershison's comment in the Q&A about money indigestion, and that's absolutely one of them. So if you're got momentum, you're going to have a bunch of investors chasing you, and they're going to give you a lot of money, or try to give you a lot of money, and it's going to be at a very high valuation. And if you're keeping score by sort of how big a step up in your valuation you've had, that can feel really good. But the reality is those investors expect you to put that money to work. And if you don't have a crystal clear plan on how you're going to acquire the next wave of customers, which has got to be bigger, right? If you're going to keep growing, it's going to be bigger and bigger. And almost by definition, that next wave of customers is going to be further away from your sweet spot, right? The first customers knew exactly why they were buying your product. And as sort of you grow beyond that, people are going to be less interested, and the feature isn't going to be quite as interesting. So you're going to start to get this squeeze between how much a customer is worth, the lifetime value of a customer, and the cost of acquiring them. Because you're going to first customers may come through word of mouth, the later customers through paid marketing, and you're scaling up. Meanwhile, if humans have to do things inside your company, you're hiring legions of employees to answer phones and emails and pack boxes and so forth. And that can be super challenging if you've never done it before. You don't have the systems for coordinating all that activity, budgeting systems, inventory management systems, customer service systems. So fast growing startups can, and this is correlated with money indigestion, can get pretty chaotic and spin out of control, and the economics can go bad pretty quickly. As long as people have faith, investors and the entrepreneur, that they can solve these problems, more money may come in, but that just raises the stakes higher, and eventually raising at a high valuation, unless you down the road, the next round will be at an even higher valuation, a higher share price. A down round can be super deadly. So, it's hard to advise an entrepreneur in the situation, because it's weird to tell somebody negotiate a lower share price for this round, or take less money. But the reality is you do have to be careful when you're growing that fast, and there's an expectation for continued growth. So that's one pattern that I call that the speed trap. There's another pattern which is related to the bad bedfellows. It's sort of the grown-up version of it, the scaling startup version of it, help wanted, where a company has a missing manager and some absolutely pivotal function. The example in the book was a company called Dot and Bow. They were online retailer of home furnishings, couches, table. Look around you, wherever you're sitting, that stuff came from somewhere. You can ship it, you can buy it online and have it shipped from the West Coast to Kansas City. A couch that when your Amazon books arrive 2 days early, you're happy. When your couch arrives 2 days early, you actually have a problem on the curb. So it turns out to be really difficult to manage the logistics of that business. And this founder was brilliant at generating demand, knew nothing about integrated logistics or operations. And again, the problem of not having a network rich with candidates and not knowing how to evaluate them when you do bring them in really can manifest itself in a big way in a scaling startup. So it took him 3 tries to find a vice president of operations who could get things under control. And by that point, they had burned through a lot of capital. And then another thing to watch out for when scaling, if you're on that kind of trajectory where you're burning a lot of cash, but growing, maybe even growing in a healthy way, capital markets do slam shut. And we hit all the time sectors where, it's food delivery, saw it, drone deployments, clean tech like crazy in the late 2000s, biotech every 15 years. So even good, healthy companies may find it hard to raise capital. And that happened in e-commerce in 2015, exactly as Dot and Bow had solved its operations problems, and then, boom, couldn't raise more money. So, and then the last pattern, it's a pretty rare one, so I won't go into detail, but some ventures are just so audaciously big and bold that they're reconceiving something. It's going to take years to do product development. And you may need the cooperation of established companies that have benefited from the status quo. There may be, think Segway, think of Theranos, think of Iridium, if people remember, hundreds of satellites or 100 satellites in low Earth orbit to do phone service anywhere, and Better Place. And these businesses, I call it a cascade of miracles, because lots of things have to go right. If any one of them goes wrong, fundamental change in customer behavior, raising $1 billion, if any one goes wrong, the thing is dead. And the chance that they're all going to go right is low. And you need a cascade of miracles if that's going to happen.
Those are the memorable ones, right? And I think a lot of maybe founders think, oh, if anything goes wrong with my business, it's going to be because I dreamed too big and all these things. But actually, a lot of the failure paradigms are more prosaic and closer to home, and
yeah. Sometimes they work. We should say, like Tesla
Sure.
Tesla and SpaceX are examples of cascading miracles that so far have worked.
Owing maybe to what you invoke is the reality distortion field a little bit. A lot of people under that spell.
Bingo. Yeah. A lot of people under the spell, and that's as long as the field keeps propagating outward as opposed to folding back in on itself. You can do great things.
Elon Musk is going on Saturday Night Live this weekend, right? So we'll have to. I don't know how to trade on that in advance. If you could get a hold of the script for SNL this weekend, you might have some insider information that actually influences the stock price of Tesla. So, okay, wait, one question from another Thomas here, and excuse me, I'm gonna close a window that's making a lot of noise. It's not the HBS campus where there's like 2 maintenance, landscape maintenance people per every faculty member or student, but living in the suburbs next to Stanford, you'd be amazed at the amount of lawn care that happens out here. So Thomas goes, he invokes this question of startups that haven't quite failed, haven't returned their money, or haven't failed to return money. They're just kind of going on. And he talked about at the outset, like companies that may never return that investment. So popularly termed the living dead sometimes. So what actually drives this phenomenon of companies that keep going rather than deciding to wind down?
Living dead, for sure. The other term, I mean, neither term is endearing. I think somebody who's actually running one of these things might resent the term, but zombies in the portfolio that can generate enough internal cash flow to keep going, but investors will never make money. Yeah, and the question is, if there's a restructuring, it's possible the management team may do okay. I mean, they're going to draw a salary, right? There's worse things in the world than drawing a salary. It's unclear whether anybody's equity will ever be worth anything. So, I've seen some, and I'm thinking of writing a case on a turnaround where a high flying was a roll up that went bad, and the founder sort of had been executive chairman, stepped into the CEO role to turn the thing around. And his equity had been pretty well wiped out in a big restructuring. And yet he just felt an obligation to the employees. They were earning their livelihood from the business. And for him, it was a learning opportunity, and it was a matter of pride. So, I mean, entrepreneurs do things for all sorts of reasons that don't have to do with money. And I think if we look at these so-called living dead companies, a lot of them are still businesses that people are proud of and happy to be associated with. So unfortunate for the investor, particularly for the investor who's still got a board seat and sort of dutifully fulfilling their fiduciary responsibilities and, without any hope of ever making money from the thing.
Yeah. And we can return to this notion of pride in entrepreneurial outcome, regardless of size of exit in a second. But I do want to cover Nadia's question, returning more tactically to some of the early stage kind of challenges around, do you have something that is novel here? She asks, how important are patents and at what stage? I mean, maybe we can take this in light of the early stage, but is it worth investing in intellectual property protection so early on? It's a general.
You hate to hear a professor say it depends, but it depends. Typical direct to consumer business or SaaS business, so many tech businesses that we would think of, just, I don't think the teams would even think about filing for patent protection or seeing some kind of intellectual property. But, anything in life sciences, material sciences, pick your term, deep tech, emerging tech, frontier tech, tough tech, patents are going to be just absolutely essential. The tricky space, and you only have to watch like one episode of Shark Tank to realize this is consumer products where you can get provisional patents and so forth. So I would say it depends a great deal. And there's large swaths, I think, of the venture capital backed universe where patents are, intellectual property protection isn't important at all.
Yeah. It's more competitive defensibility, execution, and it's great if you can protect something, but even if you can get a patent saying that this is yours, what you're going to spend in litigation to actually enforce the patent and the time distraction it will wreak on your company, it ends up being a greater cost than just blowing a competitor out of the water because you have a superior product. So
yeah.
Okay. Returning to this notion of pride in entrepreneurial outcomes, you end the book with a letter to founders, right? Look ahead, don't just take conventional wisdom that encourages you to build and grow. And even if you do or disregard that advice, like the numbers kind of end up being pretty stark, right? There's lots of entrepreneurial failure, but entrepreneurs are resilient folk and seem to fare generally pretty well for themselves. There's a certain type of person who starts a company, and perhaps that character lends itself to being able to recover from the failure of a company. But just in your experience, like, how have you seen founders navigate the downside of startup failure and rebound and kind of move on and maybe even have another go?
Yeah. So a surprising number. I didn't know the fraction of failed founders that would go on and do it again. So, grabbed venture capital backed early stage failed founders from 2015 to see they failed in 2015 and how many of them in the ensuing 5 years had founded another startup, and turned out to be over half. So it's quite common. And I think that's because entrepreneurship is a calling for a lot of people. I think there are a lot of founders who can't conceive of doing anything else. And for the founders, I think that have, first off, the failure is going to be just spectacularly painful at a lot of levels. Ego blow, financially, you've savaged your personal relationships because you were so busy trying to save your company that you skipped the last 3 dinners with your best friends. Your spouse is fed up with you. A lot of pain, and it takes some time and some distance to heal from that. And the best way to do it is alternating between ruminating on what happened, which is unavoidable, but then finding some distractions. If you're just 100% distracted, it's not healthy, and if you're 100% ruminating, you're going to make yourself crazy. So after some period of time, you can get distance, and then you can start learning. And that turns out to be still pretty hard, right? We're wired up as humans to blame other people or uncontrollable circumstances when something goes bad. And some people do nothing but that. My co-founder dropped the ball, my investor pushed for the wrong strategy, the regulators did something stupid, my competitor was irrational. And those founders probably haven't learned much. And there's a real danger if they found again, they're just going to ride the horse over the same cliff. Another set of founders beat themselves up too much, take too much responsibility for the failure. I'm hopelessly inept at this. I never should have founded in the first place. I certainly should never do it again. That's probably not, it might be true, but it's probably not true either. So you want to find that zone in the middle where you got enough distance from the pain that you can actually make sense of what went wrong. And it's those founders who can take those lessons in, and when they're talking about whatever they're going to do next, talking to people about what they learned and what they're going to do differently, they will actually inspire confidence from investors and potential employees. And and particularly if the actual shutdown of their business has been graceful. People who are owed money were paid money, vendors and employees and so forth. The combination of a graceful shutdown and sort of showing that you've learned something, actually, I think positions, at least in the US and UK and some other markets, where failure is stigmatized, but not nearly to the extent as in other parts of the world, can position a failed founder for success going forward.
Definitely. Well, there's a whole literature of startup postmortems out there that are sparked by founders who kind of navigate this period of reflection and recovery with the help of friends and with the help of resources that help them actually diagnose what went wrong. Of which I actually I really do think that this new book, I wish it could focus, Why Startups Fail, is going to be an invaluable guide, as founders diagnose what may have gone wrong, but hopefully, and you kind of stated as much, your ambition is to help that be the case less and less, right? And so, people aren't just looking back on failure and thinking, I can pick out, what I didn't do right based on Tom's book, but if I have this understanding and this knowledge of corpus of, why startups have failed before, I may be able to better to protect against failure in my own. And I hope that you all will, if you're founders out there, you'll take this into account and revisit the concepts that Tom presents and go out and succeed. And if you have to fail well, and then do it again. So, Tom, thanks so much for sharing all of these thoughts. And I know it's been nearly a decade of research and 3 decades of working with startup founders who have failed and many of whom have succeeded that's gone into this. So a lot of wisdom in it, and it's hard to get it all out in an hour, but really appreciate you.
Yeah, no, Keith, thank you so much. Thanks everybody for listening, and good luck with your ventures.
Thank you. Thanks, guys. Have a good afternoon. Bye.